Okay, so Ric, mate, thanks for joining us for the Adansonia quarterly update. Um, so we might just start with just an update on the fund, how you guys are positioned, and we'll go from there.
Yeah, thanks very much, Rob. Thank you again for having us. Always a pleasure every quarter. So look, the fund finished the year on a positive note. So for the month of June, we delivered a return of 2%, outperforming the market by 0.6%. For the financial year, for financial 24, the rolling 12 months, the fund delivered just under 22%. For the year, outperforming the MSCI World Index by 12% or 12.1%. And again, since inception, we've been running over 5 years now. We're delivering 16.3% per annum compounding, outperforming the market by about 5.4%. So we're very happy. But look, the market has been difficult. The last quarter or so. Obviously, just with several AI related mega cap stocks running where we don't see any value in them, but we can talk about that a little bit later. But the way that we're positioned at the moment, we've got quite a defensive position. So we're carrying about 15.5% cash, Rob. So essentially over the quarter, we sold down. We exited Shell. We reduced our weightings in Taiwan Semiconductor Manufacturing Company, and we increased weightings in Amazon and Alphabet, but overall, and so we also reduced weighting in. Oh, geez, sorry, escapes me. Anyway, it's in the monthly. We reduced another stock, but essentially we've got a relatively defensive position carrying 15.5% cash, simply because the market's trading on a forward multiple of around 21 times, 21.2 times, well in excess of the long-term average. And really, it's a function that the market's been rewarding bad news because it's bringing forward the prospect of rate cuts, and it's been pricing them in. But look, the fear that we have is that fundamentally the markets are expensive. It's being driven by an ever-decreasing breadth of shares, large cap shares that are driving the market upwards. But generally the rest of the market is starting to run out of steam. And philosophically, we believe that earnings growth drives share prices, and essentially the economic growth indices or the economic surprise indices are sort of bouncing off lows. We had a weaker than expected US flash PMI manufacturing printout last night under 50. And effectively, if we get to a point where the market starts to see bad news as bad news, and growth isn't coming to basically drive share prices up to justify current share prices. So growth isn't coming to drive earnings up to justify current share prices or valuations. We believe that there's a correction afoot, and I think we're sort of seeing that the market, I think, had its worst night, or the tech index had its worst night since 2012 last night, with Tesla leading the way, being down 12%, because effectively it disappointed. Essentially, profitability a lot lower than expected. Deliveries are falling, and the last quarter's news of robo-taxis, which sort of has weighed on Uber, and also, I guess, the prospect of bringing cheaper models to try and sort of reinvigorate deliveries, is sort of, I think, waned a little bit, and the market's seeing it for what it is. So stock that's been re-rated very, very slowly with earnings coming off, had a decent reality check. So that's been one of the shares, and also Nvidia continues to drive the markets up, and Apple, after sort of announced that they had a credible AI strategy at a conference several months back, has also rallied hard because it's been a laggard. So we're a little bit worried about that the market rally isn't broad, and essentially with growth being what it is, we don't think that growth is going to come and broaden the rally out. So we've got a relative defensive position, a lot of dry powder. We've got a shopping list of really good stocks that we want to basically buy, but at far better prices than what we're seeing at the moment. What we have at the moment, they're all. Again, we're a fundamental manager, Rob. We've got everything that we hold. We see value in at the moment, and the shares that we own aren't cyclical. They've got low economic sensitivity as such, so they're not they're not beholden to needing a strong economy to drive earnings forwards, and they've got pricing power. So obviously they've managed to sort of hold margins in in this inflationary environment, even though that's waning now moving forward. So we're very happy with the portfolio, but then again, it's going to be the whole index will basically, or the whole market will take a step backwards. So we believe we were positioned.
Yep. So just on that, on the 21 times earnings, I was watching a thing about this the other day. That's actually 2 standard deviations from norms.
Yep.
So probably
In the top 10.
the way to think about that, it's the reverse to the GFC, right? With the GFC, that was giving it away. Well, this one's on the flip side. Throughout history, the second standard deviation, like it doesn't, it's the top decile. It's less than 10% of time, right? So very expensive. And as you sort of also alluded to, very probably showing your age a bit here, Ric, saying that share prices should be driven by earnings. We've had over the years, we've had valuation multiples expanding, but not necessarily the earnings to go with it. And I don't know when, but I do know that it will correct at some point.
No, for sure. And look, and a lot of that will be also, I mean, again, the recent inflation print continues to show that services inflation remains relatively sticky. So, I mean, if these rate cuts don't come as quickly as what the market's pricing, that will also be a catalyst as such. I mean, so the last dot plot, was talking about one cut this year, possibly 2, we believe 2, but effectively they will come, but they'll be pushed out, and that will be that will also be cause for concern because outside of the earnings growth, I mean, what market also needs to justify the valuation is a lower discount rate, a lower cost of equity, and if that's been pushed out, then that's also going to be a headwind for markets.
Yeah, and I mean, I think the thing that gets overlooked with this, interest rates are going to go down. There's this basically underlying assumption that inflation is under control. I don't think it is. And I think there's some real concerns about the US fiscal position and the impact that that's going to have on interest rates over the longer term.
No, absolutely agree with you. And look, in saying that, putting it in some context, talking your own book to a degree, I think that the US is better positioned in terms of its outlook than the Australian market. But you're exactly right. I mean, and this is the issue you've got is that so also the market's been roiled a little bit of late with somebody trying to shoot Trump, and then obviously Biden stepping aside, and if anything, that's going to bring a bit of volatility to the market with I guess that degree of uncertainty. Although Kamala Harris seems to be the nominee elect moving forward, that's to be finalized. But the fact is that both those parties, in my opinion, anyway, are fiscally irresponsible. And yes, it's just going to be a continued tug of war between some very, very strong spending programs, and trying to basically rein in inflation at the same time. They're basically opposing forces to a degree. So yes, it's going to be difficult, but it seems to be more in control offshore. The UK has actually hit their inflation target and cut rates once already. The Eurozone is at their inflation target, but haven't cut rates because they believe that it's potentially temporary at the moment, but they've gotten their inflation down to 2 or so percent. US is on the way. In Australia, I think we're severely lagging. But you're right. Essentially, the governments are not making it easy to bring inflation down.
Yeah. So anyway, that's the uncertainties is what provides the opportunities. So it's actually, as I've said number of times over the last couple of years, it's good to see markets again where people have got different views, and they'll either be shown to be right or wrong, and it's not just simply a matter of sort of following the lead of central bankers.
Yeah, no, look, it's true. And as you say, look, I mean, you're right. In the volatility we create opportunities. And I guess with our approach, Rob, having a longer investment horizon than many sort of other peer managers. We look through a lot of the noise, and the noise creates opportunities. As I said, we've got over 15% cash, and a list of shares that we're looking to buy at particular price points, which we're not there yet. But as I said, it's the market's really very much being driven by momentum, and from data point to data point, and also by an ever decreasing group of large cap tech stocks, or mega cap related stocks with the AI theme, and it's getting mature. And I think Tesla was a great wake up call last night, and even Alphabet, which we own. I mean, Alphabet basically beat market on both top line and profitability. It was still at 5%, and a bit surprising to us. It was a good result. The market obviously a bit concerned that advertising revenue from YouTube was a little bit lower than expected, but overall the company basically is doing very, very well. So there's a lot of there's things are priced for perfection, and if you disappoint, you'll get commensurately sold off. But as I said, Tesla down 12% in a night, quite eye-opening.
Yeah, no, absolutely. So, all right, Rick. Well, mate, thank you very, very much for the update, and obviously we're going to catch up in Queenstown in a few weeks.
Yep. No, I'm looking forward to that. Putting together our presentation, and obviously I'll be posting the July performance for the fund, or sorry, for the portfolio, in a couple of weeks' time as well. But no, looking forward to Queenstown. The first time we were there was great. And yeah, no, always good fun, the conferences. So no, again, thank you for the opportunity to speak, Rob. Much appreciated.
Pleasure, Rick. No, pleasure, and look forward to hearing from you and catching up with you over there.
Thanks very much. Thanks. Have a good day.
Cheers, Rick.
Thanks, Rob. Cheers. Bye.